Okay, cool. All right, guys. Well, we're starting the next class, and the next class is a little bit more about the what's going on in today's. Okay.
What are you gonna say?
All right. Well,
We're on it.
we're going to talk about what's going on with today's lending, types of loans, what types of programs are available, and what is actually happening in the market where how people are buying homes with what type of lending options. So one of the things I want to talk to you guys about today was lending back then, and I use 1975 because that's the year I was born, I guess. I used to somebody put that on, so that's my resignation with that. So, previously when we were looking at lending, they're very much constrained. When I got into lending back 28 years ago, it was very much, you look at someone's taxes, you look at someone's credit in one particular way, and you make decisions accordingly. There's not very much leeway as to how to give people loans. Now, jobs have changed, because back then people had W-2 jobs, or you're a self-employed person. Now, jobs have changed. We've got, like for example, when I got into the business, I worked for Warner Brothers Credit Union. And Warner Brothers Credit Union, everybody worked for the bank, for the studio at the time, I apologize. So if you worked for the studio, you actually had a W-2 job at the studio, Warner Brothers. Now they only hire gig workers, right? So you go in and you do like costume design, you're out, you're working somewhere else essentially at that point. So it's very much job-based versus having to be working for one employer. Things like Uber, like Eats or whatever maybe, it has changed the industry to where people can do gig jobs versus having to have a job from 9 to 5. Because of that, people can't really document their income as easily as they used to, because you used to be able to go, here's my W-2, here's my tax returns, and I could qualify for a mortgage. Now you're getting cash, you're getting some inconsistent income from one job. So to a lender, you look like you're not a consistent individual when you make money that way. Well, things have evolved, and banks have to change their thought process as well too, because one person can have 4 different jobs versus having one job. And for their mentality, it used to be like, well, this is not a stable person. So to us, that person's stable because they're hustling to make money, obviously, right? So we call these programs AMP, accessible mortgage programs. And that's where the acronym AMP comes from. And a lot of people call this product non-QM. We don't understand the word non-QM because it seems so negative. So there's not non-QM types of loans out there, but we call them AMP. And what this is that, and apologies guys, because the font somehow did something here, it's not coming out right. So we don't call statement and NT loans, we call them statement loans. So. But anyway, so we follow, one of the programs that we do is we provide us with 12 months of bank statements from us, and we do a cash flow analysis on you. You could have worked for WAG, you could have worked for Uber, you could have had a regular job, you could have had whatever it may be. All variations are aggregated based on your statement, and we add them all up, and we say, yes, you're approved for a loan. Or sometimes business owners give us their profit and loss statements, and we make an assessment based off of their profit and loss statements versus having to go to their taxes or pay stubs. Asset loans. So some people come to us and they say, Marty, I don't have a job, but I've saved a lot of money throughout my years, and elderly people do this often, and they can't get a loan normally. When you have $5 million in the bank, believe it or not, you still go to apply for a loan. You still have to show that you can make that payment through a job, where banks will not give you a loan for that. What we do is we look at their bank statements and we say, okay, because of you've saved enough money, we'll allow you to get a loan based off of the assets that you have. And then the last one is called cash flow loans. So for those of you that, like, let's say, don't have income and you guys have flipped homes or whatever it may be at that point, and you decide to buy a property and there's no income to show for, but you come to me and you say, Marty, this property actually makes $10,000 a month, but the payments are $5,000 a month. But I don't have any income. A traditional lender is going to say, sorry, we can't qualify you. With us, we will qualify you based off of that. And I'll give you an example over here. So for example, we give an example that says, if the gross rents are $12,000 on a property and your payments are $8,500 a month, it's already covering the payments, right? Because the $12,000 of rents are covering the payments, and your ratio would be 1.4. As long as this is 1-to-1 as long as the rents over here are bringing $8,533, we don't need 1 ounce of documents from you. We just basically look at the property and we get the rents income and we qualify you accordingly. The reason why I'm talking about all these various different loan types is that I want to make sure people are understanding that you don't have to be a particular box to qualify for a mortgage. Because when you go to a bank, the bank is going to say, sorry, you're not qualified, and you're going to walk away thinking, oh, you're going to put your head down and walk away thinking you don't qualify. That's not true, because there's various different ways of qualifying for a loan. And we do this daily. Entertainment people, realtors, all these people that cannot document their income as well as the banks would want them to, but they come to us and they get a mortgage, obviously. So moving on is, I wanted to give you guys some understanding of fixed. Everybody understands fixed rates are great, right? Hey Marty, I'm only looking for a 30-year fixed loan. How often do you think you've lived in a home? Have you lived in a home for 30 years ever? No, right? Like you've rented probably like 5, 6 years at a time, you moved on. Most people in the West Coast, they buy a home and they hold on to it for maybe 5 to 6 years and they move on to the next. So if you're getting a 30-year fixed loan, you're wasting all that time that you would have gotten for a higher interest rate because you just want that security. So there's loans that are called ARMs, A-R-M, which is adjustable rate mortgages. And they are good for 5 years, 7 years, 10 years. And the rates are a little bit lower than the 30-year. So I look at it as like wasteful, right? If you're not going to stay at a place for 30 years, and this is not your final home, especially if you're building a family or it's your starter home, that's generally never going to be the case to get a 30-year fixed loan. So what I would recommend, especially in this market, when rates are going up in an inflationary market, the only solution is to increase interest rates. On a recessionary market, which all of you guys are watching the news, I'm sure, and what do they say? Recession's coming up, recession's coming up. The only solution is to reduce interest rates in a recessionary market. So what do we have ahead of us is a reduction in interest rate from where we're at today. So today, if you all decide to go get a loan and you get a 30-year fixed loan and it's at 7%, guess what? In a year from now, that rate's going to be lower. So you would have wasted 29 years of that mortgage that you would have gone for that year. So what I recommend for you guys is to get an adjustable rate mortgage today in this particular market, because rates are going to go down on the way down, next year or two, essentially. So I would recommend that. So keep in mind the adjustable rate mortgages, and then and the reason why we said, I'm sorry. And then IO, for example, what IO stands for is interest only, and this is good for people like realtors, for people, writers, or people that get lump sums of money at one point in time. So keep your payments low. You pay interest only for the duration of the loan, for the first 5, 10, whatever it is that you're going to get the loan for. And then once you get a big chunk of money, let's say a writer writes a book every 2 years, they get a big commission for that. So they can apply towards the balance that they should have paid for throughout the past years that they did not make balance payments for. Now they can apply it at any point in time. So a realtor gets every 4 months maybe, or 5 months, they sell a home and they make a big commission check. But their payments are low and are interest only for the first however long you get the loan for, 5 years, 7 years, or 10 years. And then once they get those big chunks of dollars, they could apply it towards their principal. They could say, okay, I borrowed $100,000. My payment's still the same. It's $100,000, but I got a $10,000 check. I'm going to apply it. Now my balance is $90,000. Whereas regular 30-year fixed loans, every month you make a payment, a portion of your payment goes towards your principal, a portion of it goes towards your interest. So you're paying down your principal balance every month on a regular conventional type of a loan. The other thing I want to talk to you guys about is I want to skip this one because of timelines. Is 2-to-1. It's called a 2-to-1 buy downs. So for example, you guys are on the market to buy a home today. 7% interest rates are too high. You're like, I can't afford it, Marty, and the payments are too high. And so what I would recommend is negotiating with sellers where they could buy down your principal balance by a particular amount. So not principal balance, my apologies. Buy down your rate by a particular amount, and I'll give you an example here shortly. I think it's here. I'll explain this to you guys, but maybe let me see if I could explain it to you. Let's say you guys are buying a home today and you're borrowing $580,000, and you say, Marty, my payments are too high at a rate of 5.99. They're $3,467, and we say, great for you. We're gonna have this. We have this program called a 2-to-1 buy down, And what will happen is your first year, your payment will be calculated based on a 3.99% interest rate. The second year, your payment will be calculated on a 4.99 interest rate. The rest of the years will be going back to the 5.99. The reason why this is good is because in a market like this, when we feel like the rates are going to go down, you might as well reap the benefits of getting a lower interest rate. And then in the next year or two, you could always refinance out of those loans and get back into a lower interest rate than 5.99. The seller pays for this fee. You guys don't pay for it. It's negotiated by a realtor. So in this particular case, the seller would have given you $12,800 to reduce your interest rate for the first 2 years. And then your payments would have been $2,700 for the first year. The second year it would have been $3,100. This makes it where it's affordable and you can get into the property, and then you can always refinance out of it within the first 2 years. I'm going to say it's obviously a win-win because the seller may be able to sell the higher price. So the reason why we think it's good, because the seller might want to sell that house for $600,000. In order for your payments to be $2,700, they would have to reduce their purchase price, their sales price to $500,000. They're like, wait, I can't sell it for $500,000, but I can give them $12,000 and I can sell it for $600,000, and you guys both win. He sells it for $600,000 or she sells it for $600,000, and then you get a much lower interest rate at that period of time as well too. So it's a little complicated, but I wanted to make sure that you guys understood that there's ways to buy homes with lower payments today without having to be paying the 7% interest rate payments. Because you're going to have a 7% interest rate, but you're not going to be required to pay the 7% interest rate payment for the first 2 years. The other thing I wanted to talk to you about, because of time constraints, is myths. Do you need to put 20% down? Do you guys know? No, 2 minutes? No.
We can cover some of these later.
Yeah, so
time.
You don't have to put 20% down. You don't need to have excellent credit. You can qualify for a loan if you just have student debt, because a lot of people think they can't qualify because they have student debt. You should find a house to apply for a loan. No, you should be pre-approved before you apply for a house. You go find a house. 30-year fixed mortgages are not always the best idea. That's what our job is, for you guys, for us to advise you. The only upfront cost is the down payment. No, because I'm sure you guys are going to explain that to them, is that you have closing costs as well. It's not cheaper to rent than to own, because you're wasting every single one of your dollars if you're renting. So make sure you own. I bought my first house when I was 21, and it just never made sense for me to ever rent. So your mortgage will only be monthly related expenses, not really, which I'm sure you guys are going to talk about. When you buy a house, you have utility bills, you have things that break, you have to pay for it. You can't call a landlord to have them fix that, obviously. And you do need an agent, because a lot of these times where people go online and they look for homes online, you're not going to get the best negotiation on your side. And the biggest question is, now is a bad time to buy. I just explained that to you guys. No, it's not a bad time to buy, because you could get the rates that you're getting right now due to 2-1 buy down, refinance in a year from now, and you're going to be in a much better position, because once rates go down, what happens? Prices go back up again as well too. So this is a good time for people to buy, because it's not as competitive, and in a year or year and a half from now, you can refinance and get a lower interest rate. So just wanted to end with that. Is there any questions at the moment? Yes.
Refinancing, what is the percentage that it's going to cost you to refinance a loan?
Dollar-wise,
Yeah.
it should be anywhere from $2,500 to $4,000. So your cost savings, going from a 7% to, let's say, 6% or 5%, is going to pay for that 5 times over, because of the loan amounts that you're going to borrow are going to be $500,000, $600,000, $700,000. You're not borrowing $100,000 like you would in the Midwest. So over here, when you borrow $500,000 and you drop the interest rate by 0.5 percentage point, you're approximately saving $200 a month. If you take $200 divided by the $4,000, it's about an 18-month return on your money at that point.
Are you only licensed to deal with California homes, or could you do other states?
We can do other states as well.
And one last question. Let's say if someone, it's a hypothetical, makes like $75,000 a year, this is to buy like a vacation home in Massachusetts, and they have that's their verifiable income, right? And then you run, based on your slide before about the transactions or the bank account statements, and they have like an extra, then you see that as like 125,000. But the only thing that's verifiable is 75. Does that make you ask questions?
No, because it's either or. We either go with the taxes or we go with the bank statements. So,
Okay.
so if it's bank statements are helpful to you, it's going to maximize your purchase power.
Okay.
We go with the bank statements. So sometimes the bank statements don't help you because sometimes your taxes, you are too honest and people put all their income on their taxes or they inflated their taxes. It's very rare that we see that. I've seen that happen. The taxes help them versus their bank statements as well.
You mean the 1099s and the W-2?
Correct. Yeah. I know it's a lot of information, guys, so I didn't mean to overload everybody. So.
Is there any insurance that you, as a mortgage banker or broker, has to have? You know, I just don't. Yeah.
Insurance, yes, it's called mortgage insurance, and
No,
that's
that you have, like your company has, just for not for you, but for fraud. Because I just
We
read
have
so
to.
much stuff about fraud right now, about people getting zelling a down payment to the wrong person or by accident.
Yeah,
You know,
yeah.
they're losing hundreds of thousands of dollars. So that's I guess that was my question.
yeah. So we're a mortgage banking firm, guys. It's not a mortgage brokerage.
Okay.
Whereas we're upheld with the bank standards.
Okay.
So we have to have like the E&Os, the surety bonds, the fidelity bonds. We got to have all of that stuff, and we get audited by the Department of Corporation, by the Department of Real Estate. So we're at a much higher level of,
Got it.
upheld at a much higher level, unfortunately.
Thank you.
Fortunately and unfortunately.
Fortunately for us. Thank you.
Yeah, thank you. All right, guys. Well, I'll turn this over to Cindy and.
Are we taking a break or are we gonna continue on? How does it
We
work?
should continue.
Oh, continue? Okay.